Hello traders, Greg here with a market update. Okay, so overnight the big focus for the market what basically caused risk-off trading last night was what is happening to UK 30-year bond yields. So UK 30-year bond yields last night, they spiked up to 5.7%. The last time that they were at this level was in 1988. So that was almost 30 years ago. So look, yes, it is significant and it is a big headline. And the reason why these UK bond yields are spiking up, there's a couple of reasons. One of them is that UK has a debt problem. Debt to GDP now. Debt is 94% of GDP. Government's running huge deficits. And bond investors, they start to worry about whether or not they're going to get their money back. So they demand a higher premium when they have a government that is irresponsibly spending. The second reason is inflation. So the BOE, the Bank of England, has actually been cutting rates, but they've been cutting rates into inflation actually going back the other way, the wrong way, going up. Last inflation numbers had inflation CPI at 4%. So that is not good. So long bond holders, they are anticipating that inflation is going to be sticky and a lot higher. And so again, they want higher yields. But look, this problem in the UK with what's happening in the 30-year bonds is not just unique to the UK. There are a lot of other countries at the moment that are experiencing similar issues, and it has been something that has been simmering underneath the market. So it's not exactly like a huge surprise. So yes, in France, they've got long bonds yield spiking, same as Germany. Here in Asia, Japan, 30-year bonds yields in Japan are actually spiking up to record levels. And in the US as well, the 30-year bond yields in the US are at 5%, and that's even with a Fed just about to start easing rates again. So the bottom line is that yes, the market is finally now focused on debt issue and with bonds and what's happening with the spike in longer bond yields. And it's something that certainly need to watch carefully, because if those bond yields continue to spike up, that is certainly not bullish. It can certainly crush economies. So anyway, last night, yes, we did have some risk-off trading. Equities a lot lower, and in the currency space, we did see the US dollar bid. But the biggest beneficiary, of course, was gold. Gold absolutely loves sovereign debt issues, and it went straight through 3,500, new record highs, and we settled, up near 35.30. So yes, this momentum from breakout technically as well has gathered a lot of steam, and the market is certainly in a mood, to buy gold. Just to take you back to 2009, 2010, where we had pretty much the last sovereign debt crisis in Europe, the pigs, Portugal, Italy, Ireland, Greece and Spain. And when that was going on, gold actually increased from 1,000 to 1,900, so it almost doubled. So yes, if we continue to see what's going on in global 30-year long bonds, the yields spiking up, gold's going to continue to rally, and this rally may have just started. So certainly would not be fading this gold move anytime soon. Bias obviously is to buy any sort of retracements, any sort of dips, and just to get on this train. And then also silver obviously is doing exceptionally well as well. It's almost at $41 at the moment, and no doubt that also could have a serious spike at any stage. So yes, both precious metals, you want to be buying any sort of dips on those. Today in Australia, we do have some economic data out. We've got Q2 GDP coming out. Market expecting quarter on quarter just a 0.5% increase, and year on year for that to go up from 1.3% from Q1 to 1.6% for Q2. Looks, they're pretty much average numbers. Long run GDP runs in Australia around 2%, so we're well below that. So look, I don't think this number is going to cause too much of any sort of market volatility, unless of course it comes in well below expectations. Potentially, if that happens, you're going to get a market that may think that's another reason to see the RBA cut again. The Aussie last night did sell off on the risk off that we had associated with those bond yields, long bond yields going higher. It was trading around 65 and a half, and lost about 0.5 cent. So yes, look, if those GDP numbers come below expectations, with the Aussie at the moment, on the back foot, we could see obviously Aussie then back below 65 cents, but above expectations, maybe it might perk it back up. But certainly, Aussie's got very stiff resistance above 65 all the way up to 66 cents. Other than that, at the moment, we are in September, which is seasonally the worst month of the year for equities, and also it is generally a bad year for bonds, where long bonds are generally down about 2% as well. So it is the sort of month that wouldn't be chasing risk, maybe being a bit more cautious, and maybe selling risk is probably the way forward. So good luck with your trades, and we'll catch back in with you shortly.